Emily, welcome back to the channel. Today we're talking about 2022 and what the current real estate market would do, which we all know. I'll go over tell you right now, nobody knows. I was reading back an old article from the spring from Market Watch that was walking through their revised estimates. They started around 6.6% increase in house value this year. I think that was revised from like 2.9%. And it was just interesting that, where the predictions were in the spring, but just like this, on the drop of a dime, how the market turned over. And now we're facing increased supply in most markets. All of the buyers, not all the buyers, but a lot of buyers are sitting on the sideline right now. They're not looking to buy. They're waiting out to see what's going to happen. I think there's fear in the marketplace as well too. And so the whole psychology piece, they talk. A lot of people talk about psychology in the stock market, but there's a psychological aspect to buying a home as well too. And right now, the news media is hitting, pushing, recession, less growth, job layoffs. Even though we're at a record unemployment rate, people can't hire enough people to come in right now. They're adding more jobs. We just got July data for I think it was over 500,000 jobs were added in the United States. So it's a weird time right now, and rightfully so. A lot of people are holding off on making that large expense. That a lot of times the house represents the largest purchase that any one person would make in their entire life. So some people are holding off on making that decision. You have mortgage rates on the rise. Up until this point, they've actually subsided a little bit, which was a little weird after the Fed announced another 75 basis point increase and mortgage rates drop. So mortgage rates, they are still hovering a little bit above 5%. So not terrible. We'll see how some markets are, how some buyers are coming back into the market. I know right now we had one property that sat on the market for 3 weeks. I think we had a total of 3 showings, no offers. And we had another one we just put on the market that on Friday, and as me sitting here recording this on Sunday, we've had multiple offers. We're going to highest and best that we're going to take by 5 p.m. on Monday. And two different houses. The location could play a little bit in it. One was listed for 265,000, and the other one for 135. So a little bit different. Not a lot of houses at all for 135. A townhouse. It's run its course. It wasn't on the greatest side of town. I just wanted to be done with it. Take that capital and deploy it into other assets. We're still buying multifamily apartments, so it made sense to just kind of sell that within the portfolio. But rates are kind of stabilizing a little bit, so we'll see what happens with that. The Fed doesn't meet in the month of August, so that's cool. So we don't have to worry about the news rhetoric leading up to that. What are they going to do? They're going to increase rates again. We won't have to worry about that cycle again to I think the 22nd of September, so late September. But without a question, the rates, the way that they ran up over the last couple of months has pushed a lot of people out of the market. We're dealing with that right now. And so I think sellers are still normalized. I know in my market in Panama City, we're having conversations with motivated sellers, well, semi-motivated sellers, and it's still unrealistic on some of their prices. Especially on the fixer-upper side is where I focus on value-add real estate opportunities. They're still a ways away from realizing that the market is shifted. I can't sell a property for what I could 5-6 months ago, and so I can't buy a property for that amount. And that's the thing with it, that it's just going to continue to be a cycle, but you got to buy right. As things shift, you continue to shift your numbers, and if you're buying like me, buying for cash flow, then you're going to be good, because whatever rates are, we're factoring in the rates right now. Whereas that, we're making sure that we're going to cash flow and where rents are in the area, so we can make sure that our exit strategy is good. I'm not depending on having to sell my product to another end buyer. We can refinance it as long as the bank's there. We have multiple exit strategies, lenders in our pocket that we can work with on our team that's partnering with us, and we'll be good. So we'll see. A lot of markets are being hit a whole lot harder than others. The West Coast primarily, markets like San Jose, LA, Boise, Idaho, Seattle, San Diego, Phoenix. A lot of these cities out west, they're seeing a lot of, especially a lot of these areas are some of your most expensive places to live in the United States when you start talking about California, Seattle, and out west, that they're slowing down now. There's not a lot of buyers in the market, and people aren't ready to commit to purchasing those houses. And so if you're a flipper with, 5 or 6 $800,000 houses sitting on the market, Yeah, it could be an interesting time, and I think one of the things that I saw articles with too was just talking about Open Door and some of these iBuyers that they literally, I think this was a suburb of Houston, that they bought a house 2 months ago, and now they're selling the house for $50,000 less than what they bought it for, and they had a house next door where the neighbor had their house for sale, and here it is, like, they've done multiple price drops, and now here you are trying to sell a house and Open Door is just steady just crashing the market. And so it's going to be interesting to see how appraisals start shaking out over the next 2-3 months with the people who do buy, with how appraisals are impacted, just because prices are starting to drop now. And so we're going to see that that kind of that we hear that vacuum sound with some of the wealth going out the door. And so I think that's the biggest thing is, and that's why as real estate investors, I always focus on cash flow and buying for cash flow, because that's at the end of the day, cash flow will get you through any storm. And I think one of the other things that look at is just with this the whole dynamic is with a lot of people going back to work now. The virtual employees being able to work from home, telework. It's just now as we pivot back, we're going back in offices and things like that. It's like, how's that going to impact people's buying decisions, relocation? Are people going to leave their jobs? Are employers going to want people to come back in the office? How's that transition going to happen? So that's going to be something to look at as well too. But I think we're just moving back toward equilibrium. If you see the growth that we had over the last year, 2 years, it was unsustainable. So I'm not really shocked if the market corrects 15-20%. It just went up 15-20% in 1 year. So I don't really view that as a crash. I view that as us getting back to a normal trajectory, coming back to kind of have a baseline. We had a lot of money that was pushed into the economy over the last couple of years with a lot of stimulus, with the government, a lot of programs, debt was cheap. And so a lot of people were buying. They were looking to spend money in the economy. And so that's one of the things that as we stabilize, that we'll kind of return to probably pre-pandemic numbers in our real estate market, and then just kind of gradually continue to increase. Unless, there's a mass recession, businesses start laying off a lot of people, and we kind of go into a downtrend for economic growth, then it could be a little bit more bumpy a ride. But that's something we continue to work through. And as real estate investors, we just kind of hedge our risk. And I think that's what we have to do is kind of hold steady at the helm, make sure we're listening, taking the information from the right people, and aligning ourselves with the right groups, the right community. That's why I love my coaching community, because we come together, we talk, and we're in different markets, and iron sharpens iron. And you got to be in the room with smart people that's been doing it for a while in order to make sure you know what you're doing. And I think at the end of the day, that's where we all want to be. We all remember what happened back in 2008. If not, you need to find people who lived through 2008, get those words of wisdom, their experiences on what they went through, what happened, what went wrong, what went right. And I think, looking back at '08, a lot of what I'm telling you from everybody that I've talked to in the line with is you want to have cash reserves. You want to be liquid, whereas that you can weather any type of storm. You don't want to be over leveraged. You don't want to have too much debt. Especially bad debt when you start talking about credit cards, personal loans, multiple car notes, all of those type of things where bad debt. And even with your real estate, you don't want to be over leveraged. Whereas that I think, if you're at 75% loan to value, you'll be good. A lot of times you see, especially, I'm a huge proponent of the VA loan. And so, of course, 100% financing. And I've been blessed, whereas that, outside of my first purchase that I done with my VA loan, I bought nothing but foreclosures with my VA loan from 2011, 2013, 2017, and even 2020 when I moved to Northern Virginia. I have bought all foreclosures with my time moves with the military, which has been a blessing. But, that's one of the things whereas I can remember in '08 where people who were upside down in houses where the government had a program to help military people who had to sell and were upside down get out of those programs. And so, or get out of those loans. And so that's something that's interesting because, you're kind of, when you got to go, you got to go. And if you're selling in a down market, then, that's a bad time to be having to sell. And so, something to think about just with leverage, looking back away, you don't want to be over leveraged. You want to have cash reserves, and you want to be able to buy, have the right relationships to be able to buy when you get good opportunities and when you see those deals come up. And that's what it's all about. And I think, for me, it's like when you're always looking back, what I'm measuring to understand my market, my Panama City, Florida market, my Alabama markets, where we buy at, is I want to see days on market. Right now for my MLS strategy, I'm not looking at houses that haven't sat on the market for at least 30 days. I don't want to talk to sellers whose house they just put on the market. They're unrealistic. I want people that's kind of been sitting out there, hadn't got a lot of offers, and be getting lowballed, and then come in and just see, hey, are they willing to negotiate? And then kind of go into our strategy that we use with working with listing agents. And I think that's going to continue to work well for us. We're going to continue to watch the days on market for transactions, and we're going to add different strategies to our exit or to our purchase. Going in, when we buy properties, we're going to have multiple exit strategies, whereas that we can do more deals, whereas that a lot of traditional investors, they may be unequipped to deal with certain situations where it's pre-foreclosure, where you're bringing in different terms, you're using creative financing, or all of that is at your disposal. Those are some things that you want to look at with how you can be creative, where you can get in real estate without a lot of money up front. Then I encourage you to sign up for a complimentary coaching session, see if my community is a good fit, and kind of tapping in and joining the group. Whereas that we're doing deals in this market. All this year we've been doing deals, whether it's on the single family side. I had one student that they found a 40-unit multifamily apartment building that we're in the process of taking down. And so just continue to grow is the name of the game. And so when you kind of sum it all up, it's going to come down to supply and demand. As supply goes up and demand goes down, you're going to have prices that drop. And for the last couple of years, supply has been low and demand has been extremely high. And we just saw prices continue to inflate and go up. And, I think that's where we are right now, that we're getting back in balance. We've been way up here with demand, and we're going to bring demand back down here. And as we do that, supply is going to start coming up, and we're going to get to an equilibrium, and we're going to get to an even playing field, which is going to be good for the consumer, for the end buyer, and for us as investors that know how to find deals. And so I think it bodes well to continue to get that knowledge and align with the right people who can give you that wisdom and experience for all my new investors, whereas that this is a great time to build wealth as we kind of see this shift in the market. And I love the quote from Warren Buffett that talks about, the secret is to try to be greedy when others are fearful, and to be fearful when other people are greedy. And I think right now the greedy people on the sideline. So this is going to be the time for everybody to come in to eat. And I put another video together a couple weeks ago that talked about Robert Kiyosaki and just his prediction on what's going to happen. So you can go back and watch that a little bit and follow up. And it really talked about what happened going into the Great Depression in the early 1930s. And so with that, make sure you guys, if you haven't picked up my book, Millionaire Real Estate Success Strategies, whether if you got to teach in school, make sure you find that down in the description, and go to the link and download your free PDF copy of that. And and if you're interested in joining the real estate community, would love to have a complimentary coaching session. Just sign up with that and see if you'll be a good fit for our community. And I will catch you all on the next video.